Warren here, Smartest Data Quick Definitions. WACC, weighted average cost of capital. How to calculate a WACC? Let's go to the video, define and explain the weighted average cost of capital calculation, and at the end of the video there'll be 3 quick bullet points to take away. The weighted average cost of capital calculates a company's average cost of capital from all sources of capital, common and preferred stock and debt. Weighted average cost of capital is expressed as a percent, setting a benchmark return for future investments. Companies need to fund their operations via a combination of debt and equity. The cost of debt is simply the interest rate minus a tax shield, an obligation to pay debt holders. The cost of equity is the dividend payment paid to an equity holder. For common stock, this is not an obligation, but an expectation. For preferred stock, this is an obligation which can be quantified. The average cost of capital calculates a company's average cost of capital, including common stock, preferred stock, and total debt. The weighted average cost of capital is expressed as a percent. The percent calculated determines the required rate of return on forthcoming CapEx programs. For an acquisition, a benchmark rate of return is set for the acquisition to be additive. Three takeaway bullet points regarding weighted average cost of capital. Calculates a company's average cost of capital from all sources of capital. It is expressed as a percent, sets a benchmark return for future investors. Remember, if the IRR, internal rate of return, is greater than the weighted average cost of capital, the investment is accruing value. Weighted average cost of capital is to be held at a minimum. Capital cost can be varied by changing the debt versus equity mix.